This earnings season can potentially make you a ton of money if you're paying attention to the right stocks and you're ready to execute. In this video, we're going to go over the stocks that could become huge value opportunities if earnings news cause them to drop. Now, the first stock I'm personally keeping a close eye on, one that could become extremely cheap during this earnings season, is Alphabet. This stock is already trading at surprisingly low valuation with a price to operating cash flow ratio of 15 at the time of recording this video. Compared to its median of roughly 18.5, Google is looking very cheap. We're using price to operating cash flow here because the company is heavily investing in capital expenditures, but it's not just throwing money away, it's investing into its future. But valuation is only one part of the story. We also need a strong narrative behind that valuation. For Google, that narrative or growth opportunity comes from its expansion into new and rapidly growing sectors, as well as its ability to adapt to major trends like integrating AI into how it operates as a business. Lately, we've seen stocks drop just off expected news or slightly worse than expected results. But that's not necessarily a bad thing. It creates chances to get high quality stocks like Google at an even cheaper prices, even though the business is still performing well. So it's really about taking advantage of these kind of opportunities when they come. The second stock we want to pay close attention to is Amazon. Just like Google, Amazon is heavily investing in high growth areas, most notably AWS, which dominates the cloud computing space, but also in areas like robotics and automation. These investments show the company's focus on long term innovation and scalability. Because of this heavy spending, it's important to look at price to operating cash flow instead of traditional metrics like earnings. At the time of recording this video, Amazon's price to operating cash flow is sitting around 16, which is extremely cheap compared to its median of 24. That's a massive discount for a company with this kind of scale and market dominance. Now, if Amazon, like Google, only meets expectations this earnings season or slightly misses, the stock could still sell off hard. And that's exactly the kind of situation we want to be prepared for. Why? Because Amazon has a massive moat, whether it's in e commerce, logistics, cloud computing, or even AI. The company has built huge barriers to entry in nearly every sector it touches. So, if short term sentiment pushes the stock down while the fundamentals and growth potential remain strong, it becomes a high conviction opportunity we shouldn't ignore. The first stock we're looking at has already reported earnings, and after posting a fairly average quarter, it dropped a noticeable amount. That stock is ASML. Now, for those unfamiliar with the company, ASML is a Dutch tech giant that builds some of the most advanced machines used in the production of semiconductors. Specifically, it's the only company in the world that manufactures EUV extreme ultraviolet lithography machines, which are absolutely critical for creating the smallest, most powerful chips. Companies like TSMC, Intel, and Samsung all depend on ASML's technology to stay at the cutting edge of chip development. That gives ASML something incredibly rare in today's market, a true monopoly. There's virtually no competition that can do what they do at the same scale and level of precision. Because of this, ASML has one of the strongest moats you'll find. It operates in a niche that's essential for the future of computing, AI, and virtually every advanced technology we rely on. Right now, it's trading at a PE ratio of around 30, which might seem a bit expensive, but for a company this dominant with long term contracts and unique technology, that premium could be well worth it. And if the recent drop continues, it might turn into a great opportunity to pick up a world class business at a discount. The next stock we're looking at is Uber, and this one continues to show massive growth potential. The company is still growing at a double digit pace while expanding into new regions and adapting quickly to emerging technologies. It's also steadily building a competitive moat through its large and active user base, strong brand awareness, and the network effect of its platform. One of the biggest potential growth drivers in the future is the expansion of autonomous vehicles, already integrated into Uber's platform. As this technology scales, it could significantly boost efficiency and long term margins, giving Uber a major edge in the space. On the valuation front, Uber currently trades at a price to free cash flow ratio of around 22, which is, in my opinion, extremely cheap for a company with this kind of growth outlook. That said, the stock tends to be pretty cyclical and reactive. Even slight underperformance or soft guidance can lead to sharp drops. That's why I'm watching this one closely. If we see a pullback driven by short term sentiment rather than fundamentals, it could present a strong entry point into a high potential evolving business. The last stock on the list is one that I personally want to own in my portfolio, and I might finally get the chance to buy it at a discount if the market overreacts and the stock pulls back. That stock is Visa. Visa, along with MasterCard, dominates the global payments industry. Their scale, global reach, and brand recognition have created a powerful mode that's incredibly hard to compete with. The only reason I don't already own Visa is because of the valuation. Right now, it's trading at a PE ratio of around 34 and a price to free cash flow ratio of 31. And for me, that's just a bit too rich. I don't want to pay the same multiple for Visa as I would for something like ASML. But if the stock drops maybe around 10 to 15 percentage, or if the price to free cash flow ratio comes down into the range of 22 to 27, that's when I'd seriously start considering adding it to my portfolio. Visa is a high quality, steady compounder with global dominance, and if you get the right setup, it could be a great long term opportunity at the right price. When it comes to investing, having access to real, reliable data is crucial. One platform that I personally recommend and actually use myself is EODHD. They're an API key provider that offers a wide range of high quality financial data from stocks, fundamentals to historical prices, and much more. Whether you're building tools, analyzing companies, or just trying to make smarter decisions, having data like this can really give you an edge. That's also why they're the sponsor of this video. I even use EODHD for my own app, which is currently in development, and I've found that data to be both accurate and super helpful. So definitely check them out. The link is in the description below. Now, to finish off the video, I just want to say this: keeping a close eye on the stock you hold and being ready to act when opportunities show up, that's how you build strong positions over time. You don't always have to chase hype. Sometimes all it takes is patience and the willingness to buy great companies when they're temporarily down. Of course, none of this is financial advice, just me sharing what I'm looking at and how I think about the market and the upcoming earnings reports. Thanks a lot for watching, and if you want to go even deeper into quality stocks that are about to report earnings, check out the video right here.